Howdy everybody and welcome to another stock analysis video. Today I would like to analyze for all of you the company, the Dividend King, Johnson & Johnson. This company, guys, is a pretty good staple when it comes to dividend investing, and seeing that they have been around for so many decades, well, let's actually see if the current share price actually matches with their fundamentals. So with that said, let's get started with this analysis. Starting off, guys, we're going to start with the dividend summary. As I said, this company is very good when it comes to dividends. Dividend yield of 2.4%, which ends up being $1.06 per share. This already as it stands is really good, because the fact that they're able to pay $1 per share is amazing. Most companies pay less than $1. The ones that are actually paying out $1 plus tells me that they are a lot more sustainable and they're more grounded in their business model. This $1.06 comes out to be $4.24 per year, with a payout ratio in regards to the net income of 42.76%. The 5-year growth rate on this dividend, guys, is only 5.79%, which does make sense, seeing that, again, this is a huge corporation. However, something that puts them out against the rest is that they have been increasing this dividend for 59 consecutive years, making them a dividend king, as I said before. This is really rare. The fact that a company has been paying out for nearly 60 years consecutively and increasing it for 60 years consecutively tells you that they might continue this into the future, because they do not want this specific title of theirs to go away. Ex-dividend date, guys, was February 18th. Payout date was March 8th, and they pay their dividends quarterly. Now let's come over here to the calculator. We got the ticker symbol JNJ, market cap of $465 billion, PE of 22.66. So based on this PE, is telling me that on earnings, just earnings alone, this is a little bit expensive. However, we have seen from several companies before that once we actually tend to analyze all of their fundamentals and do a discounted free cash flow on their future cash flow, net income, and shares outstanding, the target share price may come up or may come down. So we will see that later. However, just based on earnings, with a current share price of $177, telling me that this might be a good buying point right now. Now, as we said, guys, they pay $4.24 every single year in dividends per share. This comes out to be $11 billion being paid out every single year in dividends. In regards to their average 5-year free cash flow, after this dividend is paid out, they still have a whopping $8.1 billion left, making the payout ratio in regards to the free cash flow of 58%, which, in accordance to what I like to invest in, anything under 60, this right here pretty much tells me that they are 100% able to afford it and continue to increase it, even though they have been increasing it within the past 59 consecutive years. Now, guys, let's head over to the fundamentals, starting off with a net income 5 years ago of $1.3 billion to 1 year ago of $21 billion, increase of 1,500%. That is amazing. Now, something to know here, guys, is 5 years ago, they were really low, and then 4 years ago, they just completely shot up to around $15.3 billion. Now, the fact that they shot up this much, my next question will be, can they sustain it? However, as we see right here, they were able to sustain it. However, within the past 4, 3, and 2 years, they were essentially flat, and then they just shot it right back up 1 year ago. Now, the same question can be applied. Can they sustain the $20.9 billion in income that they did last year? I don't necessarily know. Johnson & Johnson, again, it's a pharmaceutical company. You're going to have to take a look at what drugs they have on first, second, and third level in regards to the FDA approval, right? What drugs they have on patent, what drugs they have coming out of patent. All of this comes into the involvement of the analysis. Now, I'm not going to go into that deep. If the fundamentals look good, then at that point, I will go into a much deeper analysis as to whether I want to buy this company or not, taking a look at their 8K or their 10K. Now, coming over to the free cash flow, the lifeblood of the company. Cash from operations less your capital expenditures. 5 years ago of $17.8 billion to 1 year ago of $19.8 billion. Increase of 11%, with a 5-year average free cash flow of $19 billion, which is actually really good. Now, something to note, guys, yes, this is an increase from the 5 to the 1 year ago. However, if you just see this graph, it is slightly increasing. It is essentially flat, at least for me. The way that I see this is 11% is good. However, I would like for this to be a little bit more consistent going up. Unfortunately, that's not really the case. However, $19 billion average and an increase of 11% is really, really solid, especially for a huge company like Johnson & Johnson. Now coming over here to the revenue, 5 years ago of $76.5 billion to 1 year ago of $93.8 billion, an increase of 22.66%. Again, something we're seeing here similar to the net income. 5 years ago, it was significantly lower than 4, 3, and 2 years ago, where in those years it remained pretty much flat. And then 1 year ago, it increased at around $1 billion in profits, or at least in revenues. Again, really, really good, but the question is, can they continue to do this? Like, you have a major big corporation like Johnson & Johnson. It is significantly harder for them to grow rather than as opposed to like a small company that has a lot more room to grow, right? They have a lot more bureaucracy. It takes them longer to get through new stuff as opposed to a younger and developing company. But nonetheless, 22.66% is really, really solid and a positive metric. Now let's take a look at the total assets minus the total liabilities. This one, guys, simulates if the company were to liquidate all of their assets, would they be able to, 1, cover their liabilities, and 2, how much money would they have left after doing so? And currently, guys, if Johnson & Johnson were to do this, they would have a whopping $15.8 billion left, and for all intents and purposes, they were in the positive in the past 5 years as well. Now, 3 and 2 years, they went down slightly, but they were still significantly above at $9.3 billion 3 years ago and $8.7 billion 2 years ago. So even though they did go down, they were still in the positive. I don't see this as a necessarily bad thing. Average total assets, guys, is around $51.3 billion. Average total liabilities around $38 billion. Average assets minus the average liabilities, we get around $12.8 billion. Now let's analyze, guys, the shares outstanding. This one tells you whether or not the company is diluting you as the investor. This is what corporate and the CEO does, right? What the board and the CEO does. In addition to announcing a dividend increase or suspension or cut, they can also say, hey, we're going to allocate X amount of dollars to do a share buyback, right? We have seen this happen before where companies announce share buyback programs. So the more a company buys back their shares, the more of an ownership you have. And also, in addition to that, the more shares they buy back, the payout ratio in regards to the free cash flow will actually come down because that is extra shares that they no longer have to pay out a dividend for, which is really, really good, right? So looking at Johnson & Johnson 5 years ago of 2.7 billion shares to today of 2.6 billion shares. Guys, on the 5 years, that is a decrease of almost 2%. And from the previous year to the current year, that is a decrease of 0.13%. So basically from the 2 year to the 1 year, they bought back around a 1/10 of a percent when it comes to their shares. This is really, really good. Now, I would have preferred it if they would have bought back a little bit more shares, but nonetheless, they're still decreasing it on the 5 year. This is still a positive metric nonetheless. They're not diluting you. I just wish they would do a little bit more. And lastly, we got the cash equivalents, and the reason why I like to point out this metric is because we're going to use this metric in just 1 second to figure out the target share price in accordance to their debt. Currently, guys, they have $14.5 billion in cash equivalents with an average cash equivalents of $16 billion. Now let's make some assumptions. Low, median, high, using 3 different factors: revenue growth, projected share buyback, and required rate of return. Guys, for the revenue growth, I use Seeking Alpha's growth tab. I see the revenue growth year over year and the revenue growth forward, and I kind of try to make an assumption based off of those 2 numbers and also take into account how big the company is. Projected share buyback, I look at the shares outstanding that we just saw. And for the required rate of return, I like to keep it 10% across the board to match the best years of the S&P 500. Now, with that said, for my low assumption, I'm going to assume a growth of 3%. And I'm going to say that they're going to buy back at around 1/4% when it comes to their shares. This comes out to be, guys, $290.94. For my media assumption, I'm going to say a growth of 5%, projected share buyback of 0.5%. This comes out to be $312.70. And lastly, for my highest assumption, I'm going to assume a growth of 7%, projected share buyback of 1%. This comes out to be $336.58. Now we need to adjust for debt. The way we do this is we take their cash equivalents and we add the net debt. If they have more net debt than cash, then this number comes down. If they have more cash than debt, then this number comes up. And as you can see, they do have a little bit more debt than cash on hand. For my low assumption, the number comes down to $289.75. For my median assumption, it is $311.50. And for my highest assumption, it is $335.38. Now, me personally, I like to add a margin of safety of 5, 10, and 15% because I don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. If you're building a bridge and you know that the max weight on that bridge needs to be 10,000 pounds, you need to overcompensate and build that bridge for 15 or 20,000 pounds because you have no idea what's going to happen, right? You have no idea what load's going to go on top of that bridge. Same principles apply with this. That's why I like to add a margin of safety. For my low assumption, I like to buy between $246 all the way up to $275. For my median assumption, I like to buy between $264.78 to around $296. And for my high assumption, I would like to buy between $285 to $318.61. Guys, the current share price is $176.92, essentially 177. So if you were to assume that my assumptions are correct, then this is an all-out buy at the current state. Now, probably a bunch of you guys are going to be asking me, how can this be possible? How can my lowest assumption be almost $120 above what it is today? And in fact, how could you even say these numbers when the 52-week high is only $179.92? Well, guys, understand where this calculator is coming from. The way that this calculator works, I have done a video up on this. It takes the future cash flows and brings it into the future X amount of years and then creates a terminal value. Then it takes that terminal value and then we discount it back using a discount factor, which comes up with a market cap. Then with that market cap, we divide by the total shares outstanding. The reason why my numbers may be a little bit higher is because I used the projected share buyback to project the shares outstanding 3 years into the future. Therefore, if I'm saying that they're going to have less shares in the future, then the value will come up because you have the market cap divided by, let's just say 100, whereas 3 years from now, I'm going to say it's going to be the market cap divided by 90. So the value is going to come up. Again, these are just my assumptions. It really just depends on to you. I personally think that Johnson & Johnson is a pretty good buy at $176. I would prefer they were to fall a little bit because, I mean, who doesn't want it to fall? But nonetheless, if you believe my assumptions, then this is an all-out buy. If you don't, I have this calculator, guys, available for free. Anybody can have it. Just go into my discounted free cash flow calculator videos. You come over here, you open it up. There's a link for it. You come over here, hit file, make copy, and you can have it for yourself. You can edit it as much as you want. You can add stuff, take away stuff, do whatever you want with it, right? It really is up to you guys. Make your own assumptions. I'm not telling you guys what to do. This is not financial advice. I'm just giving you guys raw numbers and my assumptions. All I'm asking guys in return for this free calculator is like, subscribe, comment. It really does help her with the algorithm on YouTube. We have gotten a lot of new subscribers, and I really would like to get to 500 in about 3 days. I don't know if that's possible. I'm recording this on the 27th, so I really would like to get to 500. I don't think it's going to be possible, but nonetheless, every subscription is wonderful. I love every single one of you guys. I love to build this community. I would love to get to 500 so that way I can get the community tab and talk to you guys more one-on-one, right? Now let's actually come over here and see the dividends at current price. If we were to invest X amount into this company, how much of dividends would we actually get? Seeing that this is a major dividend growth company, well, let's just do that. Let's take the average US income at $68,703. Bring it to the monthly, this is around $5,725. With the current annual dividend yield per share at $4.24, if we were to put 1 month's income, so $5,725 into this company, this would buy us 32.36 shares, which would be an annual dividends of $137.21, quarterly dividends of $34.30, and monthly dividends of $11.43. All in all, guys, when it comes to Johnson & Johnson, this is a company that I own. I do have a couple shares. I do not have a lot, but when I bought it, they were significantly cheaper. Now, I have to point out the obvious here, guys. Johnson & Johnson has a lot of controversies within the past couple years, right? I mean, they had the whole baby powder fiasco with asbestos and all this stuff. So it really is up to you if you want to invest in a company like this. Again, I'm not going to tell you guys what to do. Is your money. Just showing you guys the raw numbers. But just letting you know that Johnson & Johnson has a lot of controversies. But then again, in every single controversy, they have made it out just fine. So, that's just something to take into account. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. In regards to YouTube, Odyssey, and Rumble, I have a Let's Play channel, link in the description below, currently playing through Sonic Unleashed, so if you want to catch that, follow me there. With that said, peace out. Be on the lookout for tomorrow's video where I'm going to be doing a couple companies that their earnings are actually coming out on Tuesday. So with that said, peace out, and I will see you all next time.